and we tasted it. I'm here to admit that you were my medicine. Oh love, I couldn't quit, and I'm down on my knees again. Thank you for the happiest year of my life. Oh, thank you for the happiest year of my life. Ooh. So wake me up when they build that time machine. I wanna go back. Wake me up when you were sleeping next to me. 'Cause I really loved you. Ooh. Thank you for the happiest year of my life. Thank you for the happiest year of my life. Oh, thank you for the happiest year of my life. Yeah. Thank you for the happiest year of my life. Thank you for the happiest year of my life.
Okay. Okay, guys, welcome to another weekly market recap. And sorry if I was a little bit late. I had something going on, and I literally forgot. I didn't saw the time passing by real quick. So normally we were supposed to have these at 1 p.m. GMT, but I got caught up with time. But nevertheless, we're here already, so let's keep it moving. Oh, on UJ, I used to this week, the whole of last week, pardon, on UJ we were looking for some buys and sells opportunity, right? There's some people that still don't know when I send these. We don't know what it's like. It's all about. Okay, so I'll break it down a little bit. See as much as I can. So when you come here, you see this long position. Okay, when you see the long position, it means buy. It means you're buying this market. When you see short position, it means you're selling. Okay, so if you take a long position, which means you want to buy the market, this is what you get if you're buying the market, which means this upper side is your target. That's why you see this target here. And this lower side here is your take profit. It's your stop loss, pardon. This is your stop. This is your stop loss here. And this equilibrium is most attempt your entry. So this area can be edited to and fro like this, according to your entry, according to where you are at the market at a specific point. So that is the use of these. This is what a buy looked like, because we came here and we took long position. Now, if you would have taken a short position, it would literally be the reverse of this. You see, right? It's just the reverse. It's the reverse of this, and you see this, we have stops here, we have target instead below. Here, on the contrary, we have stops below, we have target above. So that is what it looks like. So when I send a trade, I'll be like, I send it like this, know that we are buying. Look for where the target is at. This is the target, so we are buying into that target. We are risking these stops. And these stops, if you want to look the stop, you just come here, you look at the line, tells you something around this area. The target same. Because if you move this here, right, you put a line here. The stop is 128.383. That is your stop. Your target is 142.846. That is just an example of what the stop and the target looks like. So you just invert it and you get the short position. And so on UJ, we've been buying this market, and like I always do transparency with all of you guys so that you know what's going on in the market. So we've been buying UJ for a specific time, but we had a target, right? We had a short-term target. And remember our live trading session on Thursday where we had this trade? Yeah, on Thursday we had this trade where I break this swing 4-hour point for you guys to understand where the market is more liable to gain momentum for the bullish move to these imbalances in the market. Okay, this is what I was expecting the market to do. Okay, we still have some slight imbalance that haven't been filled yet, but like I always say, we shouldn't try to be more. We shouldn't be greedy. Okay, we should just try as much as we can to understand what the market is doing as to what we expect the market to do. Okay, so we were buying the market here. So when you came to the 4-hour time frame, you saw this nice swing, right? After this sell, now notice how this sell here, this 4-hour candlestick sell here, notice how they sold right below, but it didn't close below this previous 4-hour order block, right? Now, this is where I want to draw your attention for you to observe how market operates and how it manipulates. Now, look at this yellowish line, this green line that I just placed here. This market has not, this candlestick didn't close below this order block or even 50% of this order block. They didn't even reach that area. Now, this shows that, okay, the market is gaining momentum from this 4-hour order block to reach to the upside. And where should be our upside target be? This recent 4-hour highs and this imbalance, right? And that is where the market just tried to reach, because see on this 4-hour candlestick, it should be here below, you know, and now it came again here, slipped again into this area, okay, respecting this 4-hour order block, came above, created some nice, how can I don't know how you guys that drew candlestick pattern, how do you call it, if it's a dodgy or if it's an, I don't know. And now you have a next full 4-hour kind of that the whole body covered the previous bearish candle. It created what? A swing point, right? Now, every time we have a swing point, even here, right? Let me call your attention on something in the upcoming week. Even here, this is also a nice swing point. Now, every time we have a swing point, notice how the market is always going to sip into that swing point, either to gain a bullish or a bearish momentum. Because look at the same thing that happened. After this nice swing point, and after the market has been rejecting over here, for a very long period of time, what happened is the market slipped back below into this nice swing point. And also, I always tell you guys, use reasonable stop losses so that you should be open for the market volatility. Don't have a $500 account, you use 30 lot size. No, you excuse me, use 0.30. No. If you have a $500 account, use 0.10. If you have a $1,000 account, use 0.20 or 0.30 maximum. Okay, it's going to give you time to understand how to build yourself and to understand that, okay, to be able to take losses and you can recover it back. Okay, because if you are buying this market here, look at the spread that it did below to take out people before the bullish movement. If you're buying this market here and using a tight stop loss line, 30 people would have been taken out before this bullish movement. Okay, now if you would have bought this market at this swing point, this entry, and your stop loss instead want to be where at this low, why do you want to put your stop loss here, right? Because the market has already rejected here, taking out the stop of those people that were buying here, came back again, retested from these bearish candlestick, sit below again and take out the stop of these people that were still buying this market here before the bullish movement. Okay, now the reason why you're putting your stop here is because the market is more liable never to reach at this point if it's to buy. That is why you put your stop here. It's better for you to put your stop loss where it's more reasonable than putting your stop loss closer with the fear of not losing money. That's why I really advise you guys to use a reasonable stop loss. Don't over leverage your account. Don't see me posting my result. You think you're going to get that overnight, okay? I've put in the work and I've put in the time. And I'm using ridiculous lot sizes now because of the multiple confirmation that I get off of the past experiences that I've had in this business. So when you see this swing, this was a bullish order block on a 4-hour time frame. The market sit below. If you refine it to 1-hour time frame, okay, you'll see that what on a 1-hour time frame we had this on our live trading session on Thursday. This is Thursday. If I put a vertical line here, you see this was our live trading session on Thursday that we had, that the market bought. But before the market bought, what did happen? Look at this drastic sell below. It sold and bounced off of what? These 4-hour swing point. Now, if you go back, let me highlight that 4-hour swing point so that it'll be more understandable for you guys. Okay. So, where is this rectangle? Okay, let's box that 4-hour swing point like this. Notice how when I'm trading my platform is always empty. I don't have all of these things that I'm putting now, but I'm just doing it for educational purposes. So you see how these 1-hour candlesticks came back below. Now this is what I call scaring people out of the market. I know a lot of people that will offload their position and get scared because of this sell. Okay, which is very normal. It's very normal. I've been in that position, so don't hate yourself for it. It's normal that you trip a little bit, but over time, you're going to build that confidence and understand this is a running stop. This is a running stop, actually. The market is not actually selling. It's just a running stop, okay? So once the market ran down below this area, what did the market do? It repriced back above. What did the market do? It repriced back above. And notice how on this same 1-hour candlestick, it didn't even close above below this most recent 1-hour order block, right? It just did a quick run below the people that had their stop losses here and here, take them out, and now bought back. Okay, and at the same time, that was just a running stop, guys. So ever since it came back above, you see the market having reached to this zone again. Now, if you miss these buys, you would have still bought this market at this point, but now you use instead of open loss. But now this is when you know what you're doing. This is, I don't really advise or recommend this for beginning traders or people that don't really know what they're doing. Like, nah. Okay. So when the market ran below this area and came back above, if you refine it a little bit further to the 30-minute, okay, on the 30-minute, this was a sell. This was another 30-minute sell, right? Now on the 30-minute, if you were buying this market, you will wait for this sell and you will not stay by, but you'll go again. You see the way I've been taking it from the higher time frame to the lower time frame and refining your entry in order to minimize your stop and your risk in the market. And once you go to the 15-minute time frame, observe this same area that I boxed. Don't forget the higher time frame directional bias, because that's the thing that affects a lot of people, that they don't know what they're doing. When they go to the lower time frame, they literally forget about the higher time frame directional bias, which fucks them up most of the times. So see the way on the 15-minute candlestick, the 15-minute candles have been playing off of this 4-hour bullish order block, right? So this running stop, boom, came back, closed above. If it's still here, we don't have a nice entry. How can we do? We'll go again to the 5-minute. A 5-minute, okay. A 5-minute, this is where now we get our acute entry, okay. Now, the 5-minute candlestick, we had this run, boom. After this run, we'll have a 5-minute candlestick close above, forming what? A 5-minute order block. Now, you've seen that. Now, you've seen this run back above, forming this 4-hour order block, this 5-minute order block. What do you want to do? You want to buy the market at this point. Any open and sipping below into this 5-minute order block is a buy opportunity. Where will your stop loss more likely to be? This area or even below, so that if the market wants to reprice or go back below to take out the stop of these people that are buying this market at this point, you'll still be safe. Okay, that is market manipulation. So this is where you see now a very cute entry that you could take based off of just buying it on a higher time frame. Now let's see if we have something on a 1-minute time frame. Yeah, the 1-minute time frame is a little bit more noisy, but you can still have impeccable entries on the 1-minute time frame based off of the higher time frame directional bias. So watch at this 1-minute time frame candlestick. Look at the way they have long wicks, but they don't even close below this 4-hour area. Okay, the market sit below, came back, close here, close here. Look at the candlesticks of the 1-minute, how they play above a specific zone and didn't even come below this area. Now, the 1-minute candlestick give us a very fine entry compared to the 5-minute candlestick, a very refined one, because after this swing move above, the 1-minute created what? Bullish order block here. Okay, and a break in market structure. Now, after this break, after this order block was formed here, this next candle on the 1-minute, you want to be buying the market here. Now look at the way I refine your entry from the higher time frame to the lower time frame in order to minimize your losses in the market and understand where your target should be. This is explaining where your stop is more likely to be and how to refine your entry in the market. How to understand that, okay, if I'm entering, hello? So this is to explain how you can refine your entry into this business and why the market is more liable not to reach at a specific area when you're already in this market, okay? Where to put your stop losses and where your target is to be at. Now, after this entry here on a 5-minute time frame, if you are trading, on a 1-minute time frame, if you are trading off of this 1-minute time frame, where will your target more likely to be? What do we have here? An imbalance, right? Even here, an imbalance. So the market reached there, came back, did what? Created a mitigation block. Okay, a nice one. That is another buy opportunity for you on a 1-minute time frame. Boom. What is your next target? Next imbalance. Okay, where should be your other target? The most recent high. Equal highs. We have equal highs here. Here and here. These are equal highs. Take this trend line from here to here. Those are equal highs here. Taking out, boom. Okay. And if you go to the 5 minute, these are the same equal highs here that got breached. Okay. So meanwhile, on the 5 minute, we still have our higher time frame target, which is the 4-hour imbalance over here. But watch how we still have it on a 5 minute time frame. But just see how on the 1 minute you were able to take profit like 5 times before even expecting the market to move on the higher time frame directional bias. Okay, I'm literally teaching you guys the way I'm taking the market. Once I already know where the market is heading at, how I used to stack my orders, or how I'm not telling you to do that. This is not financially advised. I'm not telling you to do that right now at your beginning stage. But once I have the ideology or the understanding of where the market is more likely to reach, that's when I start doing things like that. But look at the way that the market had reached already 2 of your targets, one imbalance here and previous side. That's already 3 TPs before even your higher time frame directional bias. Now, if you would have bought this market here, would have been here is 28 pips, and your stop loss is, let's just be reasonable and fair, it's 33 pip. It's not even up to 1:1 risk to reward, right? But yet you're almost on a 1:1 risk to reward on the 1 minute time frame.
Boss King.
Yeah, welcome, brother. And not forgetting that we are still having the higher time frame directional bias. So if you break down this now and go to the 5 minute, that's where it get interesting, right? You get interesting because you just hit your first target here. What will your second target be? Here and here, because this is where the stocks are sitting for the people that are selling this market, right? Now, if you take again the same calculation, here and here, you have 33 pip stop, and target here is 55 pip, right? Almost 1:2 risk to reward. It's getting interesting. Or better still, if we take it to the point where the market reached to the tick, 33 pips to, yeah, 61 pip, one nice 1:2 risk to reward so far. Now, refine it again. Let's go to the review. Let's increase it to the 15-minute time frame. It's getting very, 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 very interesting. As we refine it to the 15 minutes, okay, on a 15-minute here. Now, look at this clean equal highs on a 15-minute, and look at this zone. These are clean equal highs that the market is more. There's a lot of stop loss sitting out here and a lot of buy stop sitting out here. So what do you think the market would do? Do you think the market would just leave these people seated out here without taking them out? No, hell no. This is the area for a lot of stops. Now, you buying this market here, right? You buying this market here. Where will be your target? These stops. Okay, now when we were doing the math on the 1 minute time frame, your 3 profit targets to these equal highs here was not even worth a 1:1 risk reward, right? But you not seeing these upper targets, it gives you more leverage as to why the market is more to reach at this area. Why? Because we have a 15-minute rejection here, 15-minute bearish order block here, right? Which is from here to here, will give us a 133 pip, which is how much? I think that's 4:1 risk to reward if you are still risking the same 30 pips here. And notice how This was not our original entry. This is our original entry over here. Okay, this entry is for those people that came late in the market and how they can still capitalize out of these and still make money out of it. Okay, this was not our initial entry. This was our initial entry here. This market manipulation was just scaring us or scaring some people out of this business or out of the market before the market was about to do the move or whatever it is they had to do. Okay, because nobody will want you to make money in their business. Okay, let's just be honest. Let's just understand what's going on. The market needs to take out buyers. Okay, the market needs to take out a lot of buyers, a lot of us, before they move to the other direction. That's what they call smart money. Okay, but if you want to trade price action, what will you do? Or if you want to make money in a business, what will you do? You have competitors. Okay, for you to monopolize the business, you need to scare your competitors out of the business so you can gain monopoly and control the price in the business, right? Now, that's what price action did here. Okay, that's what price action literally did here. They scare a lot of buyers out, hitting those people that even remove their stop from the initial position to put it into profit, hit them off, hitting those people that had tight stop loss at the same time. Now, once they are taking them all out already, where are they heading? Here, and imbalance here. And there is an explanation video that I have educating people on how the market, if the market wants to buy, they first of all sell to buy, and if they want to sell, if they want to sell, they buy to sell. Okay, that is literally price action. So notice how I said this was not our initial entry. This was our initial entry somewhere around here, or we're trading. So this was just a mere confirmation that, okay, this stops got taken out. Now let's hold our position. And most of the times when I send my trade, I'm telling you guys, this is not a day trade. It's an intraday trade. It means it might not unfold the whole of that day, but it doesn't mean you should close your position in losses. You can still hold the trade until it reaches our target or into your profit and you're contented with it and you can close the position. Okay, I'm not trading. I'm not a scalper. I'm mostly intraday trader. I'm not a scalper. I'm not saying you get in and get out at this position. I don't do that. So when you see the market, saw the market drop like here, like let's go now to the 30-minute 30-minute time frame. Now on the 30-minute, this next bullish candle was another confirmation for a buy. Now on the 30-minute, watch how it still seep to this recent low and bounce off of this 30-minute bullish order block and boom, gain momentum to the upside, right? So exactly here, now we had consolidation. Okay, yeah, we had consolidation. Notice how the market is always doing one of these two things, one of these four things. Either the market is consolidating, retracing, or reversing. Or better still, the market is either let me check it out real quick. I think that. Okay, either the market is doing one of these four things. Okay, either the market is expanding, retracing, reversing, or consolidating. The market is either doing one of these four things, right? When the market is consolidating, what is it doing? It is building more contracts. Okay, the market has taken out the liquidity of these people that were here. Now, what does it need to do to build more contract? Consolidate a little bit. Now, this consolidation is to bring both buyers and sellers in the market that literally don't know what they're doing. People will be selling these, buyers will be buying these, and now when the buyers see these aggressive sell, they offload their buy positions and boom, the market buy. Offload their buy position and instead take sell orders, and now boom, the market instant buy above. Now heading to these stops taking out. Okay, so those are the things that you need to take into consideration when you're mostly trading and understand why price has to move in a certain way. Now you or us know what we're doing using maybe the F.I.P model, using the F.I.P model. After this consolidation, right? When you see this classic sell movement. And with the teaching that I teach you guys, that if the market needs to buy, what does it need to do? It sells first to buy, okay, and it buy first to sell. Now, what did the market did here? It sold here. What did it bounce on this area? And what was here that the market reached out? Stops. Take out these buy positions here. Take out the stop loss of these people that were buying this market here, right? Now, if we go to the 1 hour, notice how on the 1 hour, the market respected this 1 hour order block, okay? So the buy was not that, the buy was so clean for us that knew what we were doing. So the market sold here the next 3 hours here, bringing sellers in the market to think that this market is about to continue selling. But us having our higher time frame directional bias on side, we're seeing this instead as a buy opportunity. Instead to we can add more buy orders here. Okay, so if we're adding more buy orders here, where will your stop loss be? Here. Why here? Because of the fact that the previous 1 hour candlestick has already rushed down below this area to take out the stop of these people. If the market is more liable to reach here, okay, it will bounce off of this same order block and gain momentum to the upside. So it's more liable to put your, it's more reasonable to put your stop loss here, which would not be taken out. Okay, so if you're still buying it here and using an open stop, a wider stop loss like this, that's 40 p or 76 p, almost 1:2 risk to reward, not bad. But like I always say, it's not everybody that's meant for this. You need to have a certain level of understanding before you can be confident enough to take this trade here, because this is where it really gets scary. When you tell people to buy when the market is selling or sell when the market is buying, it really gets confusing and frustrating, because you're like, oh, how is this dude telling me to buy this market when I'm seeing it selling actually? So that is just market manipulation and price action in theory. So on the 30-minute, so now on the monthly candlestick, right? Excuse me. This is our monthly candlestick, okay, guys. And this is a weekly. And now on a weekly, okay, I have a higher time frame directional bias actually, but like I told you guys, I'm an intraday trader and I can hold a trade for as long as I can. So long as it has to hit my target, why not? Fuck it. So on a higher time frame on a weekly basis, we'll have a very, very big imbalance over here, right? A very big one. And the market has been selling for a very long time now. Selling here, and back above here, sold here, you know, okay? But we still have these imbalances that haven't been reached, okay? And if you go to the daily, we see these nice rejection here and this respectable area here where the market keeps respecting, right? And but yet we still have these. But this area, I think this area got, this was my fear. This was not my fear, actually. This is what I was expecting for a buy confirmation for that higher time frame weekly imbalance above. Because if this market was to go below, right, I wanted to see this market fill this area and drop even lower to these lows, right, to take out these buyers. But the market did this on the daily time frame. We sweep the daily lows below this area, and ever since then the market hasn't come back there. And ever since then the market just kept buying, okay? And ever since the market started buying, we had a nice rejection out of this zone, a nice rejection out of this area, and it sold below and bounced out of this bullish order block again here. And now the market still respects it. It didn't break it. Okay. Now we still have some bullish momentum in this market, right? But everything being equal, we still have an imbalance here. Okay. Let's not forget that the market is more liable to reach there. Now, what I want to do is I want to observe the market opening price, how price action is going to react, how the market is going to open and play out for the next 1 or 2 days. And if we look at economic calendar, okay, if we look at our economic calendar, we have Monday, we'll have a certain bank holidays on Mondays. So it's going to be a very, very sloppy day. And on Tuesday, we don't have any news. So on Wednesday, we'll have a red folder. So there's going to be a lot of movement on Wednesday. And on the Thursday, on Thursday as well, we'll have some red folders. So on Friday too. Okay. So these are the days that we are more liable to get a huge ton of volatility in the market, right? Wednesdays, Thursdays, and Friday. Now, seeing that and having that in mind, what are we going to do about that? Now, Monday and Tuesdays, if we go to the one Monday and Tuesdays, if we go to the 4 hour, right? I expect Monday and Tuesday for us to feel this imbalance here, right? Now, if these market reach on Monday and Tuesday to this area, right? This is already a bearish swing point, all of this point. But if we take our Fibonacci and reverse it, put it here in to here, right? We are at equilibrium. We're not even at 10-hour optimum trade entry here. So if we see the market reach at this area, we want to look for more sales opportunity coming Monday, Tuesday. Look for sell opportunity here. Okay. And if you were selling this market, well, we are stop loss more likely to be this high here, or a little bit above if you want to be open for spread or market volatility to do its thing. So yeah, that is where you want to see the market do its thing. Now, if the market is selling, okay, this will be our target, and this will be our target, right? So that is what I want to see this market do for the upcoming week. If it slips into our optimum trade entry, which is 0.7861, I want to look for short opportunities, and not risking that much, but reasonable enough to make a substantial amount of money, and reasonable enough to accept a certain kind of losses as well. Not to expose my entire account on just a single trade. That's bad trading. So that's what I want to expect the market to do. And having these on the lower time frame, it gave us also a shift, because with this market would have already literally feel this imbalance on the lower time frame. So there's more liquidity here on the downside for it to reach. And also the imbalance that we have here, not forgetting the imbalance we have here either, right? Take the market sells aggressively, it takes out these people here and feel these, take out these stops here and here. So that's one thing I'm open for in please. And now let's watch what gold does. Like I used to tell you guys, gold is literally, if USD/JPY is buying, gold is selling, right? That's just it. If USD/JPY is buying, gold is selling. So gold has been selling for some time here. Why? Because USD/JPY has been buying too. Okay. So if we see more sales in UG, want to expect gold to spike above. Okay. Expect gold to spike above. But where would it reach if you want to spike above? Is it these highs and these highs? And if that's the case, gold is going to create an ultimate all-time high that people have not seen in a while, right? So but let's go to the weekly. Okay. Seeing how this weekly area closed. So if UJ will be buying to gain sell order, what would gold do? Sell a little bit into these bullish order block here to buy above to these upper targets, right? So if we are looking for sales opportunities on UJ, we want to as well looking for buy opportunities on gold. And this will be our target here in here.